Welcome back. It's time to go inside out as we're joined by Ken Leon, Global Director of Industry and Equity Research for CFRA, as we discuss Netflix. Good morning to you, Ken. Thanks for joining me here on this Thursday. I know it's holiday shortened, but still markets open at least for now. Netflix, you guys are quite optimistic on this stock, and it's been a huge winner. Talk to us about sort of the thesis behind that.
Yeah, it's great to be here. Happy holiday. Netflix is a core position. We have high conviction and have a strong buy on the stock with a $14.85 target price that we raised recently. Why today and why being Netflix is it has all the ingredients for success in a world of uncertainty. What we see with Netflix is there are at least 2 or 3 steps of their competition as it relates to having a dynamic global platform that affords personalization in markets around the world. About just under 50% of their revenue is US. So the rest of the world, which is what their competitors are trying to grab, Netflix has been doing that for years. As an analyst, when you begin to look at what are you willing to pay for a company like this, of course, it's going to be a high premium on valuation. It's important that this company does a few things. One, it shows that it can continue to grow 15% plus revenue growth. This is a large company. Two, that the premium pricing that has moved up in the last 2 years, especially in US or Canada, can hold at $25 a month and still get, even though they're not giving regularly, subscriber growth. Three, and this is the dynamic that I think management will have on the conference call, is that the core businesses are still growing healthy. But what else can really drive growth in the future? And I think it relates to podcasts, events, audio, areas that can incrementally add to, again, that ingredient of having top line growth above 15%. Not very different than sometimes you think about other franchises like Apple and you're saying, where else can they grow? And I think that's a big part of their 5-year strategy to double their revenue.
That's interesting because that's the first that I've heard, a move into, some of the areas that Apple and Spotify kind of hold a firm grip on. So that makes me wonder what that looks like if Netflix becomes a key player there. Even earlier than that, we're in the midst of it, this ad rollout and this increased, kind of exposure to live events, which we know is the most lucrative for ad dollars because, hey, watching a football game after it happened just doesn't have the same watchability. Ken, the big thing with Netflix has been this was a company that used to burn cash, and now it's a cash flow machine. How does it keep that going, or is it just simply a business that you set and forget?
Yeah, so 3 quick points here. Yes, on sports or live events. I covered TKO. They have WWE, Worldwide Wrestling, which Netflix signed a multi-billion-dollar, multi-year contract to. The podcast, because if you can get Netflix subscribers to watch on your phone, interviews are short, even short takes, that's great. Analytically, when you look at this company, they reaffirmed last quarter management $8 billion of free cash flow this year. We think that can grow even much higher in 2026. They're very disciplined. So here's the rub on why the competitors have a tough time. Netflix in the last 3 to 5 years holds the line on $17 billion of programming and production costs total. And they're able to squeeze or get more return out of that versus their competitors. So yeah, it's pretty exciting for Netflix. High flyers, certainly if there's any event or disappointment, investors are at risk. But this management team's been in place for over 15 years. Mm-hmm. By the way, Ted Sarandos, who's co-CEO, he's been on the board of directors of Spotify for the last, 5+ years. So if Netflix goes into music, probably Ted has to he has to leave that seat.
Ken, I've always been so impressed by Netflix's methodical approach to how they got us all, I don't want to say addicted because I think that's a negative connotation, but let's say subscribed and watching. I think it was a masterclass in how they allowed password sharing for a decade. They got you into their world, knowing one day they always had the ace up the sleeve to turn that off. And at the time in 2022, I remember being on air with my co-host on my regular program saying, hey, look, people are going to sign up because we watch Netflix. It's not a matter of do you subscribe to Netflix, it's what else do you subscribe with Netflix? Netflix is the first choice for families and households. And I think we've been proven right since then. How impressive was how they pulled that off in your mind, and how critical is that now going forward, as they seem to be so far ahead of the competition when it comes to streaming?
Yeah, so it's a couple things. First, for anyone at home, just take 5-10 minutes and try to toggle through Netflix versus Paramount, Disney Plus, and others, and you'll see the agility and personalization Netflix outclasses them. Second, it's kind of like analysts with paralysis of analysis. There's so much programming. So the ability for Netflix to have compelling content for general entertainment still matters. And I think that's always the issue, is the stickiness, so you don't have customer churn. All that, I think, leads to a situation where, again, bringing in other types of entertainment live matters. Last, we didn't talk about, for U.S. households, $25 a month might be expensive. So there is ad pay plans, which are like $8. And that also is bringing advertising revenue from sponsors to Netflix. I think they'll begin to disclose that number somewhere like mid-2026.
Ken, final point, I couldn't help but notice the risk assessment only medium, even though it's a little bit higher beta, higher valuation name. What goes into that? And I guess the big question being, what could derail the Netflix thesis?
Well, we analysts like myself, we're a nervous lot, so you're always worried about what can go wrong here. Obviously, their scale and competitive advantage leads to certainly a franchise that we think has higher predictability than its competitors. But it is a market, and the stock, as you know, with the beta, do create risk. So quite honestly, here, as we go into the 4th of July holiday, if there's any kind of swan event outside geopolitical and Netflix sells off, probably it's to buy the dip. But what I'm saying here on fundamentals, on what I see on outlook for top line and cash flow, we're confident that we're going to get to 1485.
Good stuff. Ken Leon of CFRA. You have a good long weekend, and we'll catch up soon. Let's trade it. We'll bring in Tom White here, co-host of Fast Market. Tom, I think it was pretty clear. I mean, Ken's not saying the stock's defensive, immune to market sell-off, clearly. But if nothing's in the way, it seems like they don't see a lot in the way when it comes to Netflix in terms of it getting in its own way. It's a company with a lot of things going well.
Yeah, and it's, as you mentioned earlier, nobody's canceling their Netflix subscriptions, and I think that's one of the keys here is that the subscribers that they're getting and the growth that they're seeing, they're keeping those subscribers. And then you throw into the mix the amount of ad revenue dollars that they're getting now from that ad-supported tier, which is a big a driver of their growth that we've seen over the last couple of years here. So, to Ken's point, we're going to look at a strategy that, if the stock does pull back, hey, you're still directionally bullish on this thing where you're giving yourself maybe a cushion to the downside. I went out to the July 11th weekly option, so just really short-term positioning on this example trade where, hey, a lot of people out there are saying, I missed the boat in Netflix, I can't profit on it unless I buy the shares. Well, there's use of the option market where you can create some leverage, create some better probabilities, and still take that directional neutral to bullish stance. So I looked at a short put vertical out in that July 11th weekly cycle. Expires in 8 days, really short term. Sell the 1270 put and then buy the 1250 put. So a short $20 wide, neutral to bullish put vertical. You're going to collect roughly about a $5 credit on that. That's what you can make, $500 per spread with $1,500 at risk. But it takes your break even all the way down to $12.65 over the next week. That's about 1.5% to 2% below the current share price. So you do have that cushion. The probability that that break even of 12.65 to the downside will be out of the money at expiration, which is what you want. You want it to remain above that break even. It's about 65% probability of success on that. So you're giving yourself that better probability of success versus the trade-off of risking 1,500 to make only 500. So you're giving yourself that cushion to the downside, avoiding earnings, which are on the 17th.
Interesting. I know you got another look at well for maybe somebody slightly more optimistic.
Mm-hmm. Well, it's an expensive stock. So buying 100 shares of the stock or buying a straight call is expensive, and there's a lot of option premium. So this type of strategy, it uses and leverages that earnings event. If you think this stock's going to pop on earnings or rally into earnings, you have some flexibility as far as trade management. You could actually close it ahead of earnings on the 17th. This is out in the July 18th monthly cycle, so 15 days to expiration. On this position, we're going to buy a slightly, basically at the money call, the 12.90 strike call, and then against it, we're going to sell the 13.50 strike call. So a bullish $60 wide call vertical that takes advantage of a move higher. You're going to pay roughly about a $25 debit on that. So that means your risk is $2,500, but your potential reward can be over $3,500 if it gets above that 13.50 level. Break even, 13.15 to the upside. That's about 2.5% above the current share price. So you don't need a monster move to the upside. And I mentioned that flexibility as far as trade management goes, Alex. If the stock starts to rise into that earnings event, maybe gets above your break even, maybe this thing expands to $35, $40 ahead of the report. Well, if you bought 10 of these spreads, you can start parsing back some of your position, or you can close the whole thing if the market's open. And I think that's one of the keys with this type of directional bias trade is, yeah, there's implied volatility levels that are elevated, but hey, you don't have to wait until earnings event to get out of this, but it still has that directional bias where you need to move to the upside.
Earnings 2 weeks from today.
Yeah.
So as we say goodbye to one earnings season just a week or so ago, the other one's just around the corner.